Everybody for coming out this morning. Welcome. We're excited to see you all here. We have a great panel for you this morning. We have investing in cannabis. We have some of the, by far, leading people in the investment space in the cannabis industry here with us today. The first on your left is Brett Finkelstein. He's with Phyto Partners. He has over 16 years of experience in private equity, along with investment banking. Before his time at Phyto Partners, he was with Skybest Capital Partners. Recently, Business Insider said that Phyto Partners was one of the rising stars in the marijuana investment scene that everybody from Wall Street to Silicon Valley should know. He personally has been involved in over close to $1 billion worth of transactions, and he's very knowledgeable when it comes to the cannabis space. Next to him, we have Tiffany Liff. She's with Entourage Capital, which is formerly known as Cresco Capital Partners. She has 20 plus years of experience in leveraged finance and merger and acquisition experience. She's been very successful with real estate and cannabis investment. She has brought over $20 million in capital over the past 3 years alone to the cannabis industry. We also have Ross O'Brien. He is the founder of Bonaventure Equity. I apologize. This is a boutique, fully integrated direct investing platform and advisory firm. He has advised on over $120 million worth of transactions. And again, one of probably the foremost investors and knowledgeable speakers in the cannabis industry. So with that, I will turn it over to you folks. They will be speaking this morning all about investing in cannabis, sharing some more stories, sharing some advice moving forward for those of you who would like to get involved in the investment scene. And hopefully at the end we'll have some time for some Q&As. Thank you very much for being here.
Great, thank you. Can everybody hear us okay? So we will do a sort of de facto moderator with each other kind of conversation today and make it really open and for a lot of questions. First of all, just by show of hands, how many entrepreneurs are here in the audience that are raising capital? Okay, good. So it's mostly, so we can really focus a lot, I think, on the entrepreneurial equation. How many investors are in the room here that have invested in the space? Great. So I think the best place to start is maybe everybody has a pretty interesting story on how they got into cannabis. It's still a nascent sector. So maybe I'll start with you, Tiffany, and just give us some of your background, and we can go from there.
Sure. Can you hear me? Okay. Tiffany Liff with Entourage Capital, formerly Cresco. We have $100 million assets under management across 2 funds, including our sidecars. And we just announced our rebranded name as well as our 3rd fund launch of $150 million. So we are currently in our 3rd fundraise right now, finishing deploying the last third of our capital in our fund 2. My background, I came out of the investment banking leveraged finance world, private equity coverage for all the distressed private equity groups and their bankrupt transactions that they purchased back in the 2000s, early 2000s. Was in charge of new business and underwriting as well. I retired from the banking world for a few years to raise some small children and got back into this space doing some real estate investing on behalf of high net worth individuals. About 5 years ago, my husband was diagnosed with cancer. He's fine. But that somebody sent us at the time when he was in the middle of chemotherapy a honey stick infused with THC. And really that's what helped get our family and him through some brutal rounds of chemo and onto recovery, and that's what started me on my journey into investigating the cannabis space and the investments in that realm. So went to my group of investors that we were investing in real estate, kind of getting us all out of the private equity space and into a little more safer transactions. And I said, I know we were trying to go safer here, but I really think there's something to this cannabis space. So we really put our heads down together and made our first investment in cannabis in 2017 with a large company called Loud Pack out in California. And at that time, I was introduced to Matt Hawkins at Cresco, and through a few other partners, that we went into Loudpack with. We all ended up joining Cresco over 2018 and the beginning of 2019. So that's how the partners all came together in the space. Matt Hawkins was our original founder, and he founded the Fund 1 in 2014-15, and then Fund 2 we're finishing investing now, and then all as a group with Entourage will be raising the Fund 3. So, Brett.
Thanks. My name is Brett Finkelstein. I'm a co-founder and managing partner of Phyto Partners. We launched our first fund in 2015, just looking at the industry as a new asset class, something like internet or cable or media. We were really familiar with some of the research going on. We primarily launched the fund to invest in the ecosystem or the ancillary business of cannabis, and that, in our mind, was non-plant touching assets or non-cultivating assets. We thought it was easier to do then as far as deploying capital and making it more capital efficient. We didn't need a lot of CapEx, so under that kind of ecosystem or the ancillary space for us is lab testing, data, seed-to-sale tracking, payroll, staffing, science, ag tech, packaging, distribution, anything that's kind of non-cultivating. We've invested in a few brands lately because we wanted to get more consumer-facing. We are activist investors, so we believe that we want to invest in some competing assets in different categories. We run 2 funds with 27 portfolio companies. We're launching our 3rd fund probably at the end of this year. Same ecosystem, same mission. You know, for us, it's a long-term play. It's about the journey. We're going to still invest more capital, but I think more growth capital. We've been early investors in a lot of space, in a lot of companies, even some as small as $100,000 for discovery and collaboration. I think now, as the industry is more mature, we're going to have to deploy more capital and with more higher conviction, and we're going to start investing in growth capital. I think the industry for now, all of us, is kind of in this Darwinian mode, and the strong will survive. The markets are probably coming in on valuation, that probably are coming in, and we'll all opine about that. So we're being more selective. The 3rd fund, like I said, will be launching at the end of the year, but the same ecosystem and ancillary play, but maybe more consumer facing, and we might do some plant touching down the road. And I think that was, to digress a little, we didn't plant touch for the reason of, when we started the fund, when, same time as probably Cresco in our first fund, there was no really regulatory bodies. There was no such thing as an MSO, really. There was just guys growing in California and Colorado, and the Canadians gave us weed, and they were like, yay, weed, and we're going to go public in this health system. So we decided to kind of stay in our lanes with the ancillary businesses, have our own ecosystem, our own network connections, and use that to springboard into where we are today, and and forward in the future in 2020.
Awesome, thank you. I kind of feel like the younger brother up on stage here with the sort of newest fund out of the whole group. But I think as entrepreneurs out there that are looking for raising capital, let me start with a little bit of the bio wasn't fully accurate, so I'll give you a little bit of my background and how we operate. And I think it's important to understand that there's a lot of different types of investors out there, and it's good for you to align yourself with the people that are the appropriate sources of capital for you. When I first moved down to Florida, I was the in-house investment manager for a family office, which is a large group of private capital, and I was responsible for all their self-directed private equity, real estate, and venture capital investing. And as we were deploying money off their internal family balance sheets, we were syndicating and bringing together other co-investors, and realized that we had access to a lot of check writers and wealthy people that like private transactions. So I set up Bonaventure Equity 5 years ago as a generalist, looking at a bunch of different sectors. Have always had an affinity for cannabis. It's something that was of interest to me. Had looked at a few transactions maybe 3-4 years ago and just couldn't get comfortable with the sort of types of companies and the maturation of the different sectors, and it was still a bit opaque. A couple of years ago, that started to change significantly, and we started to see entrepreneurs that were very exciting to get behind. Went back to a group of our investors and said, look, I'm going to start showing you some cannabis deals. And they said, no, you're not. You're going to go be a fund. This is not a space where you should be, where we as investors want to be deal selecting. You're going to set up an infrastructure to go do that. You're going to build a portfolio. That's the best approach for investing in private companies. And so we kind of took our time. We've just started investing out of our first fund about 90 days ago, and we're now rolling into our second fund starting in January. But we wanted to really get an understanding of the lay of the land before we started rushing into any of the transactions that we looked at, and wanted to get to know guys and girls like this to see who's out there investing and doing some really smart stuff so that we can, everybody co-invests and does transactions together. As part of that process, we set up our own event series called the Cannabis Dealmakers Summit. So we've been hosting a finance-focused investment forum program now for a couple of years. It's been very successful in New York and Dallas and San Diego and Florida. And I also set about writing a book, which is coming out in January. And one of the things that started as a passion project was a lot of the entrepreneurs that we were talking to, I just found didn't quite have the language, lexicon, or the fidelity in the conversation around raising capital, and started just kind of taking the blocking and tackling of years of doing that to try to apply it to a practical tool for entrepreneurs. And that kind of took on a life of its own. It's being published by Entrepreneur Press. And we really dug in and started to do a lot of research, and it's largely informed our investment thesis. So as we started to pick apart what we were looking at, we don't believe, and I don't believe, and this is part of the statement in the book, that cannabis is an industry. I believe that cannabis is actually an economy, and cannabis is a trend, it is not a cycle. And there will be cannabis and cannabis-derived products in every home, period. And subsequently, it's an economy with sectors and sub-industries, and within those sub-industries, then you get to find companies that and investors that will play in, like Brett was saying, whether it's plant touching or not, et cetera. We also believe that venture capital can be redefined and applied to cannabis. Traditional venture capital has always been to finance innovation in mature markets. This is not a mature industry. We're looking at redefining the role of venture. So we're happy to stay in sort of an earlier stage in a lot of investors. We're writing $1 to $5 million checks for a Series A or bridging into a Series A with companies that have some inflection points but could use some rocket fuel. And with that, we've also built an operations platform. So we have a back office accounting and finance team that we leverage for our portfolio. We have very very significant relationships. I was actually personally involved in privately some of the drafting of the language of the Safe Banking Act. We have some very strong relationships in government relations going back to, and a number of investors who are lobbyists going back to years in healthcare and some of my background. So we think we've got some insights into where things are going regulatory-wise, how to influence that. We've got an operating platform, some capital, and we've got a really high-powered advisory board that we're building out. We anchored our advisory board with the former president of Mexico, Vicente Fox, and as of yesterday, we've actually announced, and this will be sort of coming out publicly, that Ricky Williams is also joining our advisory board. So we're really excited about the pieces we're putting together, but this is all for the entrepreneurs. So with that, maybe, Tiffany, you'd like to start. What sort of advice would you give to entrepreneurs if they're starting out raising capital, and how should they approach it?
I think for us, we have, in the early days, we were obviously in the seed round because that's all there was. As the industry's grown and we've grown up, and we're kind of in later growth stage type of investing now. So, if you're an earlier stage company, there are specific funds that are geared towards that, such as we have a relationship now with ArcView Ventures. So anybody in the early seed and bridge to a Series A, we're putting through the ArcView venture stage. But I would say from an entrepreneur perspective, if you're looking for capital in seed, particularly, or early stages, that the amount of books and decks and information that are thrown at companies like ourselves and ArcView and Phyto and yourselves are ad nauseum. So if you're trying to pitch directly to funds, you have to do something that stands out, and just not sending a deck and not sending information that somebody has to spend an hour digging through. If you can make yourself succinct to kind of a one-pager and give all relevant information, that is very helpful when somebody's receiving 15 to 20 books a day and information a day, trying to dig through it, particularly in the seed stage. Obviously, is the later growth stage companies that we're looking to invest in now, most of them have aligned themselves with some sort of investment bank or somebody to help with that process. And those investment bankers are really becoming very well known in the space to us, making themselves well known to us. And I would say if you're raising money, 15, 20 million, and you're in a B or you're in an A type of round, that it is probably beneficial to align yourselves with those people. You'll get more attention when you're coming into a fund such as ourselves. And it's easier for us to break down the information through them than typically through the CEOs or the entrepreneurs.
We look at it the same way. Sometimes, we look a little backwards because we run funds, and it might be for us about portfolio construction. The one tip I would give, or a few tips I would give entrepreneurs or issuers, is kind of know your audience. You believe that sometimes the people on the stage like us or the investors have a lot of the power, but the entrepreneurs and issuers have power too, because they really should be interviewing the people who they want capital from. And the capital might not be the important thing that they need from this investor. It might be the strategic alliances in their ecosystem. And so kind of, a tip would be know your audience, know who you're going to. I don't think you have to give people history of how big the industry could be. I think that you have to really understand your business and tackle how you guys are going to win and focus on the stuff that needs to be focused on. If you're a startup company, I would focus on the management team and what you guys have done before this. If it's a little growth capital, like Tiffany said, I would discuss where the company's been. I think for all of us on stage, none of us have seen pro formas that were ever met in this space, and the timeline is usually a lot more drawn out than it's supposed to be, or assumed to be. But for us, we've had 28 names in portfolios, and we use these CEOs and our own ecosystem as kind of helping us with due diligence. So we have awesome ninja type style CEOs that could sidestep a lot of the noise. And I think for all of us up here on stage, that's really important, because like Tiffany said, we get a deal a day, and they're always the best deal. And I guess going back to the beginning of time for us was, they all look good. They all look good, and this is a new asset class. But now, we have analog. We have 5 to 6 years into this space, not only in our fund life, but in the whole space, that we could look at winners and we could look at losers, and if we could kind of put companies in subsectors. So if it's a distribution company, we could look at analog from other distribution companies. If it's a lighting company or a tech company, there are other lighting companies and tech companies in the space. If it's a SaaS company, or even a cultivation or a brand. So we would use those kind of analogs from other different industries to kind of model where this industry and where the investment horizon is going to be. Because as time goes by, performance is going to matter, and fundamentals are going to matter. At the beginning of our investing, it was a lot of exuberance, a lot of passion that kind of fueled this market. But right now, we're at a time where fundamentals are going to matter, and the strong are going to survive.
So, and Brett, I interviewed him when I was writing the book as well, and this is something really interesting that you've hit on, Brett. You made the comment of projections versus actuals. I would say outside of cannabis, and having the benefit of going back to being an entrepreneur since I was 19 and raising money and deploying capital and doing M&A and sitting on boards, the whole thing, lifetime, I am O for lifetime against actuals and projections, right? Like, your projections never end up being what they are, and that's not just unique to cannabis. And that was part of the reason why we took the approach of trying to get in front of this idea of cannabis industry versus other industries, and we felt that a lot of the blockage in the conversation between entrepreneurs and investors that we were seeing was because there was two opposing views. It was either I'm a legacy cannabis operator and you don't understand cannabis, or I'm a legacy private business investor and you don't understand investing in private companies. If we can move past that, and that's largely what we're trying to do, and get down to the fundamentals of how a business operates and the management team. Look, for me, when looking at financials that we get, we know they're always going to be wrong. So it's not about whether your projections are correct. It's what is the thinking and the entrepreneurial acumen that's gone into developing that. Because as an entrepreneur myself, we know that you don't have enough resources, you don't have enough time, you have imperfect information, but you got to make decisions to build a business. That's not unique to cannabis. So Tiffany, when you look at your background, what you were sharing with me earlier, more broadly in private equity and buyouts, et cetera, what are some of the qualities of the successful management teams that you're seeing that are adaptive to cannabis today?
So obviously in the initial phases, it was an entrepreneur with an idea. There were not filled out C-suites in the space, and that was understandable at the time. But right now, where we're seeing people become successful. The entrepreneur has the original idea, and it's great, but you have to fill out your C-suite with people that have experience. You have to have a strong CFO. You have to have somebody that can put true projections in place, and show the basis behind those projections. I mean, that's the biggest thing that we see when we're looking through things and we look at projections and they talk about going from 0 to 80 million in 6 months and then to 160 million. I mean, it's an improbability. It's just, it's not realistic. It's not going to happen. The regulatory environment changes so much in this space that, there's just roadblocks along the way that you have to be prepared for. So when you're talking about, a particular sector, say you're doing craft cannabis, I mean, the model should be based on the market for craft cannabis, where your expertise is in the craft cannabis space, what % of the market you think you're going to be able to take of the craft cannabis space, for instance. Not just we're going to, we have great brands and we're going to go from 0 to 60. The model has to be broken down specifically and realistically, and we have to be able to believe in that. So the CFO is a key role for us. And then if you're going and moving into that branded product, you want somebody with CPG experience. Doesn't necessarily have to be in the cannabis space. You have CPG in beverage, you have CPG in all sorts of other industries that you can pull from. So kind of where we look and where we're very focused now, particularly in the higher growth capital, is a rounded out C-suite. And somebody who has been able to pull in people because they have either a product that is phenomenal and that these type of people can see a future in, and they've been able to come to this, and they've been able to bring them into the company and round their C-suite out from that perspective. So I would say, like you're saying, projections are, I mean, we really don't believe in as many of the projections. We're going to rip those apart and underwrite those in our own model and our own entry and exit analysis. But if you don't have a management team that can support those and understands every aspect of the chain of how you're operating in whatever vertical you're operating in the cannabis space, we're probably not going to look very further from there.
Yes, same with us. For us, it's all about people. Certainly in the early stage of companies, I mean, we would like to see some sort of IP, if it's on a tech side, some sort of market share differentiator, or even path to revenue. But it's really going to come down to people and management team. Early days, we didn't see a lot of teams that we kind of would not help. I mean, we're activist investors by a mandate. It's not an option to us. Right now, 2019 going to 2020, we're humbled by the entrepreneurs coming into the industry. We really focus more on that than like Tiffany said, projections. We rip apart decks, but we also look at the management team and the advisory board and the board of directors. We kind of assume why these people would come to this industry. Most of the people that we see now are coming from other industries. No one really was in the cannabis space if you weren't growing out in Colorado and California. So we like to see these entrepreneurs find other people around them to build out their management team, and that's usually in the shape of board. A lot of the C-suites, like Tiffany said, are not built out, and we kind of try to help with them, but we're humbled by people leaning into the space. And I think it's going to get a lot more important for these founders to understand that having a good idea and being a young, passionate entrepreneur is not enough to build a business. You're going to need a full team of people on the C-suite, but also in other levels. And I think a lot of it's going to come from board members, and a lot of it's going to come from people like us that are investing in these companies and trying to help them direct that as well.
Particularly from the operations and sales side. I mean, you want people from other industries that have been able to scale a business once you get to the level of, the higher end growth capital that we're talking about. So if you don't have that, it's very difficult for us to look at a company and say that you can go from 30 to 80 million. I mean, that's a big jump in revenue in a short time frame. And you have to have people rounding out, not like Fred said, not just your C-suite, but those lower levels, a VP of operations, a VP of sales, that have had experience in other industries that can scale, that have had scalable experience in other industries. It's key in the higher levels in the raising of the B to get you to that next level. It's very key in what we look for.
So on that point, and I think it's telling what's been happening in the public markets. It's great to see the investor enthusiasm is there, because clearly it means societally we're accepting cannabis is here to stay, right? But when we a lot of times get into valuation conversations, and that's what I'd like to hear your perspectives on, you know, we just wrote a shareholder letter last week to my investors talking about, you know, looking at the example of 2000 with the dot-com bubble and pets.com being the poster child for the biggest blow up. You know, it wasn't that people didn't want to buy their pet supplies online. Chewy's just sold for almost $2 billion after building for 7 years. It was wrong time, wrong management team, etc. So we have this moment where there's been a lot of enthusiasm and investor enthusiasm in the public markets that aren't traditional, that don't seem to be based on fundamentals. How are you having the valuation conversations at an earlier stage when those are sort of the most explicit, you know, companies to look at and benchmark against?
Valuation is that kind of 9-letter word that you're going to have a fight with the issuer of. You know, it's never, for us, it's about discovery and collaboration if it's early stage, but again, going back to kind of where the industry is now, there are baselines, there are analogs that you could look at other industry and say, no, that valuation is wrong. Valuation on the issuer side is always going to be a lot higher than the investor side, but and the devil's going to be in the details for us as investors. You know, we're going to structure term sheets with negative rights and pro rata shares and anti-dilution, and put it on the investor, and put it on the issuer as far as with a company, as if you do not perform, we are going to own more of that company. No issuer kind of doesn't understand that the valuation and dilution is going to happen down the road. We've been investing mostly in the private arena, and the public markets are down 60-70% in the last quarter, based on kind of where they should be. You know, that's the market is what it is, and these companies were trading it, you know, in Canada, you know, on assumed capacity and, you know, patient count, or if they sold as much cannabis as they can produce. Right now, the market is like any other hyper-growth industry. It is kind of going to play out. There's going to be a lot of failures. Valuations are coming in. You know, myself and Tiffany had this conversation. Patience is going to win in this market right today. You know, patient capital, waiting for the valuations to come in, understanding the horizon of investment, and kind of sitting on the sidelines and having those open discussions with, and they're hard discussions, talk to an issuer about where these valuations are. And I think that if people understand that it's, you know, a lot of these issuers or companies take it personally, that if an investor invests, what do they get? Well, they get a team. They get a team of people like us that are going to help them. So I think that, going back to the valuation question, you know, issuers and companies really shouldn't be so cognizant of what am I giving up. It's really what are they getting.
Yeah, I think, you know, also what companies have to be aware of when you're talking about funds is, you know, we all have LPs that we report to. So we all have a fund return profile. And when you're coming in and telling us you have zero revenue and you should be at a $100 million valuation, well, you know, our fund return profile is 3 to 5 times. So at some point you have to be held accountable to true metrics. And true fundamentals. And, you know, I like this business a lot better than the .com, because in the .com I never could figure out where anybody was making money. At least in cannabis, you have a consumable product that people come back for. I mean, it's manufacturing at the end of the day. So there's obviously there can be fundamentals in this space, which there weren't ever in the .com era. But so yeah, in general, the valuations have come down 5 to 6 times in from the, I guess, investments that we may have all been involved with in 2018 to now. And the benefit of that is, you know, we were protected with discounts to the future rounds. So, you know, as far as valuation goes and us being protected as funds, I think we're all in a pretty decent place. But as far as the entrepreneurs and the companies, I think they're struggling to, you know, with the dilution in order to provide future rounds, you know, that are down rounds, and not want to be associated with a down round and having to dilute themselves in order to, you know, have the prior investors in it at a more realistic valuation to raise money again. I mean, it's a tough conversation to have with the owner of a company and the founder of a company, but at the end of the day, do you want your company to survive, or do you want to and have these tough conversations and make the tough decisions and have the dilution, or do you not want to be in business? So I think it's, those are the conversations I think a lot of us are having right now, and they're not easy. It's a tough time. But I think everybody is going to come out on the other end understanding that, your feet are going to be held to the fire a little bit on revenue. I mean, revenue, profitable, selling product at profitable margins, not just selling product to sell product, knowing, where your core business is and where your margins are. So I think we're rationalizing right now. It's going to be a tough year, but, I think that as long as everybody can understand that the days are over where you doubled your money in 12 months, or tripled your money in 12 months, and there's a little bit of patience, like Brett said, I think, we'll all end up okay through this whole process.
So, perfect timing. I was just going to say, I think we have some time for some questions, so maybe we'll open it up to the audience.
I could probably be heard without that.
It's recording.
So, turning the tables with the entrepreneurs out here, why should at a potentially harder conversation and lesser value, what are the advantages for being in the portfolio with other industry companies compared to cobbling together a group on the outside of individual investors that may not have that synergy of having other sister companies? You have some examples of how some of your portfolio companies were helped by being part of the portfolio.
For us, I think, again, we're active as investors. I believe that we could change the trajectory of a company because it's not our first rodeo. If you're a single company issuing, just looking at your own company, we have a different set of lens on it because we have 27 right now, and we have optics of the industry from regulatory to financial to a whole team. I'm not suggesting that you shouldn't cobble together money. I mean, if you could cobble together money, then you should cobble together money. I think with a fund, for later stage growth and help, we could amplify, let's say, a growth of a company based on a place in the industry. I think we add value to a cap table. If you guys go out and raise more money down the road, you have a committed fund that kind of backs you and supported you and helps you through the thing, and through your journey. But I'm not suggesting that you should not try to go find capital. You should shake as many trees as you can.
Yes, I agree you should do that, but I think the benefit of having we have 32 portfolio companies, so we have companies across the United States and all different verticals within the space, from extractors to branded product to dispensaries. When you can introduce and have growth through portfolio companies being introduced to each other through summits with the portfolio companies, I think that's just absolutely invaluable. We had one portfolio company in San Diego not have a low-dose, microdosed edible product. We had another company in our portfolio that is excellent at making a microdosed edible product. We introduced the two of them. They were able to get in each other's spaces. One was able to sell to the other. The dispensary that was looking for that, everybody was coming in and asking for that. They were losing traffic to other dispensaries because they didn't have a low-dose edible product. Those conversations take place daily in our shop and in our portfolio management. And I just think that is a very, very easy way to grow your business and to help your business through making one phone call to the people that fund you. Not only that, but Brett said, I mean, we are a fund. We save 30% of our fund for follow-on investments into our portfolio companies. I mean, we have to help you guys succeed and move forward. And I think that if you are working with us and we're seeing quarterly reports and we're having quarterly updates and we're having these conversations, we're seeing where you're potentially struggling. I mean, don't forget how many decks we see a day. So we understand we're, the ecosystem of cannabis, just from the amount of deal flow that we see, regardless of, not to mention obviously the 34 companies in our portfolio. So I think it's invaluable to have a fund in your cap table, absolutely invaluable.
Go ahead.
Tiffany, this is really for you because you mentioned CPGs, and I believe CPG is probably the most important piece of cannabis moving forward. If CPGs commoditize, cannabis is going to get commoditized. There's proliferation. I mean, you look at people that try to open up a cannabis business, there's proliferation everywhere. And strains are pretty much the same across the board. So how much weight, when you invest, do you put into a retention strategy to preventing the switch from somebody going into a competitor dispensary as it proliferates?
Well, you mean within like a specific state, or you mean as it goes national?
Yeah, we go with Florida because it's got a lot of licensing per dispensary and so per company, and they're going to have 1,000 dispensaries soon, right? The next couple of years. So, how do you retain customers, and how much weight do you put on an investment if the entrepreneur has a proper retention strategy of getting customers to come back and repeat business with their own dispensary as opposed to a competitor?
Yeah, I mean, I think Florida's a different market. We don't have investment series. It's still medicinal, and you don't really have branded products here yet. But I think out west in California, where there's a lot of that different competition, I think that the footprint of the dispensary is very important, and the placement and how many people they're able to service and get through their system, and the array of product that they have. I mean, I don't mind if my dispensary in San Diego is selling the same product as my dispensary in Oakland. They're not typically competitors, and we manage our portfolio so that we are not allocated to many dispensaries in the same area. So we're not as concerned about that. And most of the dispensaries in California, which is where we are invested in, most of them sell their own branded products, so there's not a lot of that going on. And other ones have exclusive licenses and distribution within their area or their locations through ease or other avenues. So we haven't really seen that that to be a problem yet, to be honest.
And the delivery, home delivery, way into that as well, is that something that helps with being a customer?
Yes, I think home delivery is going to be more valuable than it is today going forward. Yeah, that is, I think eventually as brands get national, people have national brandings, which we're not seeing yet in the space. People aren't going to want to go and stand in a dispensary anymore. And once you're able to see advertising across the U.S., and people aren't going to want to probably sit in a dispensary and spend an hour getting their product. They're going to probably want to have it delivered. So yes, I see that being something we're very interested in and focused on as the space matures and potentially becomes legal nationally.
Do we have time for any more questions? Microphone over there.
5 minutes. 5 minutes.
This is a question directed to Tiffany, but either of you may comment on that. So Tiffany, you made comments, I believe, that you prefer to have great CFO. On the other hand, you said that in any case you're going to rip apart the performance. So my question is, assuming that you get a quality CFO and they get through the rigorous analysis that you're going to make of the performance, what are you looking for in that assessment? And then on the next level, where you're going to run it through your model, are you trying to reconcile certain ambiguities or uncertainties in the original performer to some assumptions that you've made, and do you share those assumptions with the group?
The basis is we want their projections to be steeped in some sort of fact. So we don't want them to say we have the best beverage in the space and we're going to take over the space because we're the only ones to figure out X, Y, and Z. They may have been the only ones to figure out X, Y, and Z, but the beverage space in general is only 2% of marijuana or cannabis sales, say in the state of California right now. So it's hard for me when I take the whole this is what I want to, these are what we're looking for in projections. Somebody to say, this is the space, this is our sector, this is our subsector, we're going to take 20% of our subsector. In my instance with craft cannabis, the craft space is only 25% of the dollar spend, right? So you can't, I don't want to see you're going to take 50% of the space because your product is the best X, Y, and Z ever. The whole craft space is only 25%. So you're only going to take a percent of that. And I want to see that ramp and build. I mean, those are the granular levels that we're looking at. I also, I know craft cannabis sells for more than just traditional cannabis, but you can't tell me you're gonna sell craft cannabis for 3 times what somebody can get just regular cannabis for in the dispensary. Like, those are the things we're not gonna buy into, and we're gonna start to rip apart. So we just wanna see them based on fundamentals, not just, we have the best product and we're gonna grow it, year over year, 150%.
I think we had time for one. Sorry, go ahead.
Can you explain why the valuations went down by 4 to 5 times? Is that because there's an abundance in California? Is that general to the rest of the states and all kinds of companies? You said from 2018 to 2019, the valuations went down.
Yeah, I think go ahead. I'm talking a lot. You go.
Yeah, anyway.
I think that we have to have a basis that these valuations were definitely a lot higher when we started these industry on the fund side for all of us here. Mostly fueled by a new industry, a new asset class, and passion and exuberance, and not really fundamentals. So as the business keeps maturing, there are fundamentals that these valuations come down. We don't control the valuations on the public markets. It is what it is. There's maybe more sellers than buyers to compress the industry. On the private transactions, a lot of times we can set those valuations, and we do see them coming in now just based on, like Tiffany said, they're fundamentals and analog. Years of 3 years or 4 years of the industry maturing in certain markets, certainly California and Colorado, we could look at that market and say, yes, this is where the market should be or is based on facts and data and industry analysis. So it's not for us to kind of set the market. Yes, we would like to invest in companies at the lowest valuation for our fund, for our LPs and our investors, but the market, like any market, any other asset class, is going to find its own way.
So it wasn't a specific law or specific anything that happened specifically, it's just a maturation of the market.
And I think also Tiffany said before, there's, in any of these companies in new asset class, or not even new asset class, but any industry, there's execution risk. But then you add into the regulatory risk that we didn't really even touch on, that certain laws and certain, when we look at projections, let's say if it's a CPG company or brand, or Tiffany mentioned craft cannabis, that's only in California or only in Colorado, you kind of have to understand what the market is in those specific states. So it's not like a shotgun approach to, we're going to make a water company and sell it in 50 states. There's certain laws that you have to abide by, and that's kind of where we would look at our own valuations and our own internal projections based on how much market share you could possibly have in certain states.
And just to the regulatory front, I mean, you look at the vape gate that we're going through now, and where Massachusetts, banned all vaping in general. I mean, you're looking, there are a lot of very, very excellent vaping companies out there that, that only sell that form factor, that were 15-20 million of revenue, last quarter. And all of a sudden now Massachusetts and now California's talking about it. I mean, that's pure panic all of a sudden. So it's like Brett said, the regulatory risk is huge. Execution risk, regulatory risk. I mean, it's, there's a lot of considerations that go into valuation and understanding that. I mean, if you have somebody who has different form factors, it's a lot easier to understand where their market's going. You can take a little bit of a hit on the regulatory side. Somebody who's strictly in the vape market, for instance, and doesn't have any other form factors they sell, there's a lot of regulatory underwriting that has to go into that.
So we're out of time. If we missed your questions, I'm sure we'd be happy to stick around afterwards and talk a little bit further. Brett, Tiffany, thank you so much for being on the panel today as the de facto moderator. Thank you all for joining.
Thank you so much, everybody. If you want to head down to lunch is being served downstairs at the same place as yesterday.